I'm Greg Hunter. Welcome to USAWatchdog.com. The very first interview of 2016 was one of the first interviews of 2015. He is a brilliant guy, an expert on silver, expert on the economy as well, expert on the markets, been around the internet for a long time, has a huge Twitter following, huge social media following, and the reason why is because he's a smart guy. I'm talking about David Morgan. David Morgan, thank you for joining us today on USAWatchdog.com.
Well, Greg, once again, thank you for having me, and hopefully I can live up to your introduction, but thank you.
Oh, I know. You have a huge following. Your website is silverinvestor.com. Did I get that right? Silver-investor?
Actually, we're rebranding. The new site's going to be themorganreport.com.
Oh, okay, the Morgan Report. Well, you also have the Morgan Report, which is one of your subscription services that you sell for a reasonable rate. And you put out a lot of work into that, a lot of research. So you're not just a silver guy, although you are the silver guru, a silver expert, which we're going to talk about. A lot of people want to know about that. But you also know a lot about the economy. And anybody who trades metals or works in the metal really has to know a lot about the economy. That's what I say about Jim Sinclair, is that he's a gold expert. But if you're a metals expert, you really have to know. You have to be like Bruce Lee. You have to train every part of your body. Because right. You never know. Anyway, so I want to start off with the economy, dreadful economy that they keep telling us is fantastic. And the realtors are freaking out with this 10.5% drop, with the Fed raising interest rates into a declining economy, clearly a declining economy. And realtors are freaking out. Do they have reason to fear the Fed to continually raising rates? Wouldn't that kill off the housing market?
Well, it certainly could. Last month in the Morgan Report, the final issue of 2015, December, I said that I didn't think a quarter point would be that big a deal. But I went on to explain that, one, I could be wrong because the system is so leveraged, and when you're in a highly leveraged system, it works both ways. In other words, when you're right and you're long and you're correct, you're going to make a lot of money. And that trade has been going on basically since gold peaked in 1980. The best trade you could have made for 30 years plus would have been to go long bonds, because what happened was the interest rates have been falling. When interest rates fall, bond prices go up. So this has been a gift. And the bond traders are there for self-interest. They're there to make money, period. They really don't care about the fundamentals. I mean, there might be a few. But most of them are there as a self-interested party. And so what I said in the report was that we could see this thing go maybe 1, 2, perhaps even 3%. And I did that to outline this very important point. At some place, is it at 0.25%? Is it a 0.5%? Is it 1%, 1.5%? I don't know. The market does. At some point, the trade will be not to be long the bond, but to be short the bond. And once that happens, these guys, what we used to refer to as the bond vigilantes, will be making money because they are betting against the U.S. dollar or against the U.S. bond market. And is that happening? Well, this is where you kind of get a market sense. You look for where are you getting clues. One, you're getting in the debt markets in the junk bond area. That is a precursor to the better debt, which is U.S. government debt, supposedly. The real estate market, as you just outlined. So it's a long answer, but it's an important answer, because what you're starting to see is those little rumblings that happened before the big tremor. That's an analogy. That's a metaphor, and that's what we're starting to see. So, Greg, I personally think, having gone through the 1980s and being what I would call overeducated, studying monetary history so avidly, and thinking to myself when Volcker came in and raised interest rates up to like 17.5% on the short end and 20% on the long end, that was it. It was over. It could not go another 2 months. And you know what? I was wrong. So since I have that experience, I got a different experience than some of the people that are in the financial arena right now. It doesn't make me better. It just makes me older. And because of that, I'm a little remiss to say, 0.25 is going to be it, or half. I think we could go longer. Is it going to help anything? No. And the last thing I want to bring up is when I did the interview at the Silver Summit. I said part of the reason that no one else is talking about, to my knowledge, is that by making the dollar even stronger, they may get some of these people that have exited the dollar, have circumvented the dollar, which is China, Russia, Australia, Africa, all of these countries that have said, we don't want anything to do with the dollar. This BRICS formation, if they raise interest rate and make it the strongest kid on the block, there may be less impetus to move out of the dollar, and maybe some of that money will come back. But nobody's talking about that because, believe me, the Fed doesn't, one, know what to do, and two, may be trying this as a trial balloon to see if they can get some of the people that used to take this ticket to paradise to come back in as a sucker. But it doesn't seem to be working at this point. So long answer, very important answer. Nothing is more important than the debt markets and what's going to happen in the future.
A lot of people just think that we're headed for a crash. We have been mathematically headed for a crash. I mean, in the big picture, people just think that people talking about a crash or a financial calamity since 2008. So, well, it's been going on since 2008. They've kept this thing. They've suspended accounting rules. They've allowed fraud in forex. They've allowed fraud in LIBOR. They have covertly and overtly printed money. They bought bonds. They haven't. I mean, what do you mean? We're in an emergency issue right now. The Fed is in emergency policy still. So people say, well, when is it going to happen? It's happening.
It's happening.
And it's going to be Michael Burry, the Dr. Michael Burry, who made, I don't know, hundreds of millions of dollars, maybe a couple of billion. He was part of the character The Big Short, which is a movie out now. And he is running a fund out in California. And he was quoted recently saying, the little guy is going to pay in the next crisis. In other words, a crisis is coming. Another crisis is coming. Now, he looked stupid in '06, stupid like a fox, because he was betting against the housing bubble. And people were mad at him for, locking them into his hedge fund and saying, I know it's the right trade. He was right. Mm-hmm. And now he's saying that there's another crash. Now, you said there was going to be a crash in 15. Of course, this is in September. And, this is, some things did happen in September. The Fed was so freaked out they couldn't raise rates. We had a 1,000-point flash crash that they had to put out, the fire out. And, but still, I mean, this is a big thing coming, whether you were right or wrong in 15. At some point, and sooner than later, the crash people are going to be right, are they not?
I believe so. I mean, I've thought this for a very long time, and as you said, mathematically, it's a certainty. Secondly, the biggest knowledge from monetary history is that no fiat currency has ever gone indefinitely. They've all failed, 100%. So why will the dollar continue indefinitely? It won't. The hard part is saying when, but it will take place. And the analogy on that I'd like to give is sort of like the avalanche. And when an avalanche starts, and this is, Jim Rickards' The Last Snowflake kind of thing, is when it starts, it actually breaks. It starts to move rather slowly, but it's a mass. It's mass times velocity. It's momentum. So what happens, it starts to go kind of slowly. In fact, you might not even notice it. And then all of a sudden it starts to pick up speed, and all of a sudden bang. So it goes slowly to quickly. Most crashes are taking place. As you said, it is taking place. What people don't notice is that it's moving or moving against them, or it's going to hurt them. They aren't aware of it until it's too late, because once the acceleration starts, acceleration means picking up speed, as we all know. It picks up speed so rapidly that all of a sudden they're buried. And I think that's a good analogy for where we're at.
Well, I think the crash, that avalanche you're talking about, did start in September. I mean, we had that flash crash where everybody's trying to get out of the market. The Fed is so freaked out after telling us for 2 years, we're going to raise rates. No. And then we started getting these dreadful retail numbers, dreadful ISM numbers, dreadful manufacturing numbers. I mean, dreadful Baltic Dry Index numbers. I mean, is that the beginning of the avalanche that's moving slowly? All those numbers everything started down. Everything started pointing down in about September. Is that what? So in a way you were right in September, and in a way you weren't. We didn't have a total full-on 1929's 500-point crash, but you're saying the avalanche started in September.
Yeah, I'm agreeing with you. I think it probably did. I mean, these things are very easy to analyze in hindsight, very difficult to analyze in real time. But no, I think that's accurate. I think we've seen all those things. And the Baltic Dry Index, I think it's the lowest it's been since forever. One thing I think I need to point out is that the ship sizes have increased over time. So the amount of goods per ship is greater than it used to be. So it's not an apples-to-apples comparison. But still, with that taken into account, I still want people to know that, yes, it is very, very low. I mean, things are really at a standstill. This is the biggest fear that the Federal Reserve has, and it's called pushing on a string. If you push on a string, nothing happens. They have tried forever to stimulate the economy by increasing the debts, by increasing credit. and the credit's all gone to the bank. And, having an aeronautical engineering background and flying for many, many years, it's called the backside of the power curve. What happens no matter what airplane you're in, when you get to a certain point and stall out, no matter how much power you've got left in that jet, you could give it firewall it, which means push all the power in, but you're on what's called the backside of the power curve. So no matter how much power you give it, you are going to stall and you're going to fall. You're either going to have enough altitude to recover or you're going to crash in the ground. That's a perfect analogy for where we are, because we don't know if we're going to fall into the ground and crash or if we have enough to recover. I'm not sure we have enough to recover this time. So the analogy is that the Fed has been printing and printing and printing and printing, which is equivalent to pushing the pedal to the metal, giving it full force. The most you can print, keep it going. We're going to get out of this thing. We're going to get out of this thing. We're going to print and get out of this thing. And you know what? We haven't got out of this thing. Greg, you know it and I know it. Most people that are awake and aware know that all this printing has not helped at all. But yet the Fed's up there, the Ministry of Truth, saying things are great, they're better. In fact, it's so good we can raise a quarter basis point. Well, let's see what happens in the future.
Well, we're still in emergency measures right now. We still have emergency measures, period, the end.
Right.
So we're still in an emergency. Great analogy about the avalanche, great analogy about the salt. I think the avalanche you talked about started in September. Now, some people may come on and say, well, he missed it. He thought it was going to be a crash. What do you say to people like that?
Well, yeah, I try to be as straight up as I can. I mean, I never claim to be perfect. What I said in my letter, I think I did on a couple interviews, was the definition is 10% move. We didn't really get it. We got close there in September. Look, the market, I've always said the market knows more than me. I kind of, look to Richard Russell as the grandfather of all newsletter writers. Brilliant guy, straight shooter, love the man. God bless him. I have a lot of his influence on me is pretty strong. And the idea is that, look, markets know more than anybody, and that we are in a position where it could happen. Just because it didn't happen when I said doesn't mean it won't happen. Well,
Greg Van Reno came on and said the market would peak in May and had a chart and a graph and all that, and yeah, it did. And so, what I want people to understand, and I hope you can help me with this, is have them grasp that this is the biggest. This is the mother of all financial calamities coming because the debt is bigger exponentially than ever. Is it not? Isn't this the biggest crash ever? Isn't it a little hard to pinpoint the biggest crash in the history, in the recorded history?
Yes, if you go back to my, my primary website, silver-investor.com, and go in the archives, if you're so bold, and start reading the stuff from the early 2000s and read some of my early work that's in the public domain, it still remains there. What I said is almost verbatim what you just said, Greg. I said, this is the most, let me start over. This is the most important and scary financial system ever, and here's why. In all other financial crises with a currency crisis, it's been a select area, such as the Weimar Republic. You could have gone to Austria, you could have gone to Italy, you could get out of it. But this time it's global, because the U.S. dollar is the reserve currency of the world. So as the dollar goes, so go all currencies. Now, since I wrote that in the early 2000s, the BRICS has been formed, and they are going to try to circumvent a dollar crash, and perhaps they'll have some success. I say some. They can't get out of it. Basically, everything is tied to the U.S. dollar. So as the dollar goes, so goes the entire economy on a global basis. That's what's so scary. As you just said, you repeat one more time. This is something that will affect almost everybody on the planet. It's that important for people to understand.
Silver is in the high 13s. Gold's in the 1050 range. I was telling a friend of mine the other night, I said, everybody I've interviewed and everybody that I've talked to, I'm thinking you're going to look back at this in 2, 3, 4, 5, 6 months, I don't know. And you're going to say that, people are going to ask you, you got gold below 2,000 an ounce? You got silver below 25? Oh, you're going to look like a genius. I mean, and it may not even, and we may not even have a dollar to measure it against at some point in the distant future. I don't know. What is going on in the gold and silver market? Silver, 13, high 13s, gold's 1050s. What's going on in those two markets? Let's start with silver.
The psychology has been broken, basically. I mean, when silver dropped from 26 and gold from about 1550, those levels were very important from a psychological basis. Markets move not so much on price and earnings, although that's part of it. They move on psychology, they move on emotion. And
But they also move in this market on manipulation?
oh, absolutely. And so the situation is that a lot of people have given up. A lot of people are interested in markets are waiting for it to be even lower, that kind of thing. So the market's stagnant. It's old. It's not fresh. We need new buying. Most people who have bought are holding. But that doesn't mean we're not going to have our day. We absolutely will. So we just need something, some catalyst or some move that's going to take place. And it could just happen subtly. I mean, as Jim Diane says, the cure for low prices is low prices. On the silver side, fundamentally, couldn't be better for all kinds of reasons, but just drilling down a few of those.
Well, wait, hold on. Let me just ask you a couple of questions.
Sure.
Is 13, I don't know, 80, 50, or whatever it is right now, 1390, 14, is that the mining cost? Is that the mining cost?
Every major miner worth his salt cannot make money at that level, save one, Tahoe Resources. So there's only really one primary silver miner on the planet that can survive indefinitely at these prices. Everybody else would have to eventually close shop. They just would fail because they cannot make a profit at these levels.
Okay. And this is what happened before mining costs with gold too. That there was, I don't know, 1,000 an ounce or 900 an ounce, whatever it is for gold per ounce, and silver is around this level. Is the actual cost to get it out of the ground and stamp it into a coin? That's where we are right now.
That's correct.
And then, what are the other good reasons what are the bullish reasons for silver at in the high 13s?
Well, I read The Economist, which is tough for me because their political views are so different than mine, but I try to push that to the side and read the black and white and stay objective. And they basically said the commodity cycle's over. I think I pretty much agree with that, but that doesn't mean the metals can't go up because they're the top tier of all commodities in their money and they are outside of government purview. So governments hate real money, all the governments. So you've got that working in your favor, and you've got the slowdown of commodities, which means base metal prices, which means 70% of the silver supply comes from base metal mining, or maybe 65%, somewhere in that range. And so if the copper, lead, zinc is falling off the wayside, bang, you're not going to have as much silver coming out of the ground. The second thing, if you go back early, the rule on the Silver Eagle program started in '86, Congress mandated it had to be domestic silver supply. Well, they only mine about 20 million ounces a year, and of course there's been a demand like 45 million ounces.
That's right.
A few years ago, Congress had to, one of these things you don't read in the mainstream, of course it's not major news unless you follow silver, is they changed the law and said, oh no, we can get silver from wherever we need to keep up with the silver demand of the Silver Eagle program. So that, of course, is, the change of law and, of course, taken place. So, the U.S. imports more than they can mine by about double just to keep up with the silver coinage program, let alone everything else that goes on in the technological base. So you've got increasing demand, at least at the coin level, from the retail markets, and some insist that that's institutional buying as well as retail, and it certainly could be. And then you've got a less supply coming out of the commodity sector in general because commodities are sliding down with the oil price. So all this stuff is coming together. Meaning that, the turnaround, is it imminent? I don't know. I think certainly in 2016 you're going to see better prices than you see today.
Well, what happens if the Fed, and you were saying, I don't know if they're going to raise it only a quarter or a half or what. What happens at the point when the Fed goes, oh, we've gone too far, and maybe they've gone too far already. I mean, according to retail home sales, they're freaking out over a quarter of a point. They're freaking out with a 10.5% drop in sales in November. And what happens if the Fed, what do you suppose would happen if the Fed comes out and makes an announcement in, I don't know, in an election year, that we're going to suspend our raising of interest rates, or things get so bad, we're going to knock that quarter of a point back. What do you suppose happens then?
If they do it that early, I think they lose all credibility. I mean, they are in the proverbial rock and a hard place. Darn if you do, darn if you don't. They really aren't a fix. I mean, they're praying that they could probably get interest rates up to, let's say, 1.5% as an example. I'm not saying they can. I'm just giving you the answer. And the answer is they're praying they could get rates up to 1.5%, say even 2%. Then they could come back and say, oh, the economy's not doing good. We'll drop it down.
They don't have that long. I don't think they have that long. Do you think they have that long? Do you really think they have?
No, I want to be consistent. What I said in the December issue of the report is that at some point, as I said earlier, the bond market is going to go against them. And once it goes against them, that market's bigger than the Fed, believe it or not. You say, oh, the Fed controls everything. They control the discount window. The Fed is not nearly as powerful as most people believe. In fact, you go back to Martin Armstrong's early work and look at some of his early stuff when he was still captured, let's say. He went through a very good dissertation on, the meaning of a lot of things and why gold is this or that. But he did a very good job, in my view. And he talked about the Fed's power and the inability to control things once the market forces take over. And I agree with that.
And so you think at some point the market's going to call BS on the BS because,
Yes.
all the numbers are phony. I mean, except, all the government numbers. But sometimes when you get these housing numbers and then you get these ISM numbers and you get those are not phony. And you get these Baltic Dry Index numbers and you get these real numbers. I mean, they're saying the economy is great. We just had a 10.5% drop in housing sales. What? Huh? What? Baltic Dry Index looks like this.
Right.
I mean, huh? What?
Well, it's newspeak. I mean, it's straight out of 1984. War is peak. Freedom is slavery, and ignorance is strength. I mean, it's those three things. You're looking at the real world, and most people don't see it because, war is peace. I mean, what kind of, newspeak is that? Straight out of 1984. And a lot of people don't even know that they don't know. They're looking at the mainstream media, and they're actually buying into this. I mean, I've got someone very close to me I won't name that reads the New York Times and thinks everything in there is sacrosanct. Are you kidding me? I mean, but, you come from a journalism background. I mean,
the spin, the non-journalism, I've been dogging out USA Today for putting op-ed pieces and passing them off as stories on the front page of their paper. It's news analysis.
Yeah, sure it is.
What? It's an op-ed piece that you're passing off as a news story. But anyway, listen, I want to get to this, my last thing for you, because this is your first guest of 2016. Give me your thumbnail for 2016. We're starting off the year with shaky numbers. Do you think it gets better or it gets worse? What's your 2016 outlook?
I think we're going to muddle along. I think you're going to see strength in the metals, but not significant strength unless there's a huge one-off, crash kind of thing that pushes the metals higher and it becomes a go-to investment. I don't see that happening, but it could. I mean, there's so much going on the planet, geopolitically with this war situation. We are playing with fire, literally, across the board. We're doing it from the war scene. We're doing it from the economic scene. You've got this cyber war going on in the background. This currency crisis is part of the cyber war story, and we don't talk about that very much. So, that's about my best. I mean, projecting in the future. I said in this last report that will be published over the weekend that, look, I'm not going to make a very big forecast this year. I think they will be stronger because it's the go-to investment that's outside of the matrix, but I don't expect huge increases in metals this year unless, again, there's some big, huge event. But I think it's very important that you prepare early because I'd rather be early than late. And I said, I'll just do it in real time, which is why you subscribe to a service like mine, is that, you can analyze a month out or 2 months out a lot easier than you can go for a year because it's really hard to pinpoint these things.
So before we leave here, morganreport.com, is that up? Is that up and running yet? Or
yes,
is it still silver hyphen?
Yeah, thank you for that. Well, both sites will always be up.
Oh, both sides are up. Okay, but we're going to go. But when I link to you, it's going to go to the morganreport.com.
Yeah, go to the morganreport.com. There's a new speculation we want everyone to get for free. Just put in your name and your email. We'll send you that. And then lastly, Greg, I didn't ask me, but, going back to the book, I'm going to plug it a little bit. But, one of the biggest questions I get is about the silver manipulation. So this is going to take about 2 minutes, okay?
Okay.
I'll just read the last page about that chapter. The Sharpe ratio equals the average return dividend by the standard deviation of returns. I know this is financial language, sorry, but it's what I'm good at, and it's very understandable. A high Sharpe ratio means that the average return is high given the level of risk. Frauds and manipulations have high Sharpe ratios. For instance, Bernie Madoff's Sharpe ratio was 133%. While the benchmark Sharpe ratio is 19%. The table below shows gold's overnight intraday Sharpe ratio over different time frames. Remember, Bernie Madoff was 133%. So if you go into the 1968 to 2014, the overnight ratio is 72%. 1970s, 92%. 80s, 41%. 2000s, 167%.
So you're saying that when it turns, it'll turn hard.
Well, I'm saying that.
It'll turn big, it'll turn hard.
I'm saying if I was asked to be an expert witness in a courtroom and try to prove manipulation, and I gave this example that Bernie Madoff's Sharpe ratio is 133, and the manipulation in the gold market was 167, I think I'd have a pretty strong case just on that one metric. And there's tons of metrics in that chapter. But that's the easiest one to understand because people get the idea that 167 is bigger than 133, and Madoff was one of the biggest scams ever. So, this idea that is the market manipulated or not, if you really want to see if the silver market is manipulated or the gold market, that one chapter alone. But, again, it's a bit of an academic read. I want to apologize for that. I've been a maverick my whole life. Not everyone agrees with me. Believe me, 99% of the people don't agree with me all the time. And I've lived with that my whole life, and I'm comfortable with it because the truth is very powerful.
Well, speaking of the truth, I want to just get this last thing in. So you told me about it in the pre-interview, and this wasn't part of the interview. I just want to get this in. You're having a conference in Las Vegas, just briefly. It's a solutions conference. The link to try to sign up for that conference is on your website, themorganreport.com. Is that correct?
Correct, and we're going to have feature basically the authors of this book, Chris Martinson and Adam Taggart.
Good guys.
We're going to talk about solutions because I've talked about the problem for a very long time, and frankly, I'm a bit tired of talking about the problem. I will really want to give people solutions, and that's what this conference on the 22nd of February in Las Vegas will be about. So certainly there'll be a sign-up page here shortly, and I hope to see you there.
And that'll be on themorganreport.com is where we're sending, which is formerly a silver-investor. That's all that traffic is moving over to themorganreport.com, correct?
That's correct.
All right, and that'll be on your front page, an obvious place of themorganreport.com.
That's correct.
Okay. Hey, listen, David Morgan, thank you for kicking off 2016. Really appreciate it. Thank you for joining us today on USAWatchdog.com. David Morgan, themorganreport.com.
Greg, thank you so much.